Michael Burry has made another bold move, and this time, it's a complete shakeup of his Scion Management portfolio. In the first quarter of 2025, Burry was holding just a single stock, Estée Lauder Companies Inc. That concentrated bet raised eyebrows across Wall Street, but now, in a dramatic shift, he's trimmed that position by 25%, freeing up capital for a completely new wave of investments. What's even more intriguing, Scion has now taken positions in 5 different stocks, and 4 of them are deep in the red this year, down anywhere from 20% to 50% YTD. The 5th, it's bucking the trend, up 36% YTD. This raises the question, is Burry once again leaning into his contrarian instincts, executing a strategic buy the dip while the market is distracted? This fits perfectly with Burry's long-standing philosophy, one he's hinted at in past interviews, that the best opportunities often come when the consensus has given up. As he's paraphrased before, the greatest investment gains come from being early, not from being popular. In today's market, where elevated interest rates, sticky inflation, and lingering recession fears are pressuring valuations, most investors are fleeing volatility. Burry, it seems, is doing the opposite. The significance here can't be overstated. We're in a market where the S&P 500 is near all-time highs, yet under the surface, many individual stocks are still in a bear market of their own. Burry's pivot could be signaling that he sees asymmetric upside in select beaten-down names, the kind of setup that historically precedes big wins for patient, high-conviction investors. In this video, we'll break down the 5 stocks Michael Burry just bought, explore why 4 of them are trading at steep discounts, and analyze how this move fits into his bigger macro play. This is the kind of strategy shift active investors can't afford to ignore. First on the list is Lululemon Athletica Inc., ticker symbol LULU, a brand that's become synonymous with premium athleisure and an almost cult-like customer base. Yet, despite its global recognition and loyal following, the stock has been hammered this year, down sharply from its highs. This drop has been fueled by a mix of macro headwinds, including cautious consumer trends and steep Liberation Day tariffs on key sourcing countries like Vietnam, Taiwan, and China. But here's the twist. Michael Burry just made it one of Scion Management's largest new positions, signaling he sees opportunity where the market sees trouble. Lululemon's strength lies in its powerful business model, high-margin branded products with a loyal community-driven sales approach. International growth remains robust, with China delivering over 20% revenue growth in the most recent quarter, supported by store expansions and rising same-store sales. Management is actively countering tariff impacts by diversifying supply chains, raising select prices without alienating core customers, and leveraging its pristine balance sheet with over $1.3 billion in cash. What's more, Lululemon generates strong free cash flow, allowing it to expand globally, protect margins, and buy back shares when valuations are depressed, a clear sign of management's confidence. In a retail sector often plagued by discount-driven competition, Lululemon's brand equity, financial discipline, and global expansion strategy set it apart. For contrarians like Burry, this is a textbook case of short-term fear creating long-term potential. Next up is Brooker Corporation, ticker symbol BRKR, a name that may not be as mainstream as big tech or consumer brands, but in the world of scientific research, it's a heavyweight. Brooker is a leader in advanced life sciences equipment, best known for its dominance in nuclear magnetic resonance technology, a field-critical tool in everything from structural biology to cutting-edge drug development. These machines can cost over $10 million apiece, creating a formidable moat against competition. Recently, the company has faced headwinds. A slowdown in academic research spending, driven largely by NIH funding cuts, has hit one of Brooker's core customer bases hard. This, combined with broader economic uncertainty and elevated tariffs, has weighed on sales and investor sentiment. In the latest quarter, revenue dipped slightly, and margins compressed as costs rose, sending the stock down nearly 19% from Burry's average buy price. Yet, the long-term story remains compelling. Brooker is actively diversifying beyond NMR into consumables and reagents, higher-margin products that provide steady, recurring revenue. Management is also implementing $100 to $120 million in cost savings while integrating recent acquisitions to strengthen its product portfolio. Importantly, there are signs of pushback against deep NIH cuts, which could stabilize demand in the years ahead. For patient, contrarian investors like Michael Burry, Brooker's current valuation, the lowest among its peer group, could present a classic mean reversion opportunity. Its technology leadership and potential for operational recovery make it a stock worth watching in the high-stakes world of life sciences innovation. Third on the list is Regeneron Pharmaceuticals Inc., ticker symbol REGN, a biotech powerhouse navigating a critical transition. The market has been laser-focused on the decline of its once dominant ophthalmology drug, Eylea, which is under intense competitive pressure from Roche's Vabysmo and new biosimilars. Revenue from the franchise fell sharply in the latest quarter, squeezing margins and weighing on sentiment. But that narrow view risks missing the bigger picture, because Regeneron's growth engine is alive and well. The real star is Dupixent, its blockbuster immunology drug developed with Sanofi. Dupixent delivered 22% global sales growth in Q2, now running at a staggering $17 billion annualized pace, fueled by a steady stream of new FDA-approved indications. On the oncology front, Libtayo continues to expand its reach in non-melanoma skin cancers, while the newly approved Linvoseltamab adds a presence in the competitive multiple myeloma space. Regeneron is also making strategic bets in obesity therapeutics, aiming to pair next-generation GLP-1 drugs with treatments that preserve muscle mass, an innovative angle in one of the fastest-growing markets in healthcare. Financially, Regeneron is in a position of strength, holding over $17 billion in cash and marketable securities with minimal debt. This war chest supports both R&D and strategic acquisitions, ensuring the pipeline remains robust. For contrarian investors, the current valuation looks conservative given the company's diversified revenue streams and strong cash generation. While Eylea's decline is a challenge, Regeneron's mix of established blockbusters, expanding oncology portfolio, and pipeline innovation could drive a powerful second act. Fourth on the list is Marcato Libre Inc., ticker symbol MELI, often called the Amazon of Latin America, but in reality, it's much more than that. Beyond its dominant e-commerce marketplace, Marcato Libre has built a fintech powerhouse through Mercado Pago, enabling millions across Brazil, Argentina, and Mexico to transact, invest, and access credit. In Q2, revenue surged nearly 34% year-over-year to $6.79 billion, driven by strong GMV growth across all markets and an especially powerful rebound in Argentina, where volumes soared 75%. What's grabbing attention, though, is the company's deliberate decision to sacrifice margins for growth. By expanding free shipping in Brazil, boosting marketing spend, and offering competitive discounts, Mercado Libre is solidifying customer loyalty and strengthening its market moat. Critics worry about the near-term impact on profitability, but management sees this as an investment that can be scaled back if needed, a lever they control. Fintech remains a major growth engine, with credit revenues hitting $1.3 billion and total payment volume rising 31% year-over-year. Despite a slight rise in leverage due to loan book expansion, the company's balance sheet remains healthy, supported by strong cash reserves. In a region with rapidly growing internet adoption and under-penetrated digital payments, Mercado Libre's combination of scale, logistics network, and financial services integration positions it for long-term dominance. For investors like Michael Burry, this mix of strong growth, strategic reinvestment, and an addressable market still in its early innings makes MELI a high-conviction bet in a volatile but opportunity-rich environment. Finally, we have United Health Group Incorporated, ticker symbol UNH, a healthcare titan that's recently been under intense scrutiny. In May 2025, the sudden resignation of its CEO and confirmation of a DOJ investigation into potential Medicare fraud sent the stock tumbling and earnings estimates sharply lower. Add in rising costs for Medicare Advantage plans and policy changes impacting its Optum Health segment, and the near-term narrative has been anything but smooth. Yet, even in the middle of these challenges, one indicator tells a different story: dividends. Alongside its latest earnings, United Health raised its quarterly dividend by 5.2%, marking yet another year of consistent growth. That's not just symbolic, it reflects the company's confidence in its underlying cash flow. Even if operating cash flow were cut in half, payout ratios and dividend cushion metrics suggest the dividend remains well covered. United Health's scale is unmatched, serving millions through its insurance, care delivery, and pharmacy services. It generates strong recurring cash flows and has a long history of navigating regulatory and economic shifts. With a veteran CEO returning to stabilize the ship, a historically high dividend yield, and shares trading at a valuation discount to both its peers and its own norms, the setup is striking. For contrarian investors like Michael Burry, this could be a classic case of short-term fear overshadowing long-term fundamentals, where patience and disciplined capital allocation might turn a clouded outlook into a compelling recovery story.